Hey everybody, Daniel Char here, and in this video, I'm going to explain the difference between a loan and revolving credit. Let's check it out.
You have not enough minerals.
Alright, so what's the difference between a loan and revolving credit? Well, a loan is something that you're going to borrow money for, usually a very large purchase, like a car or a house, and you have to pay the balance down to zero in any given amount of time. It could be 48 months, it could be over 30 years. So eventually, by the end of the term, you have to reach a zero balance. That's what a loan is. I'm borrowing money for a large purchase, but at the end of the term, I have to have a zero balance. I have to pay it off. So revolving credit is basically a product that you could use for any types of product. It doesn't have to be a big purchase. It could be big or small, but at any time you can pay it down and reuse it. It's infinite. So give you an example what a revolving credit is. So think of your credit card as revolving credit. So when you have a credit card, doesn't matter what the limit is. If it's $1,000, you got $1,000 credit card, you can max this credit card off. As long as you pay off the $1,000, you can reuse it. And you could use this over and over and over, infinite amount of times, okay? Until you close the card or your card expires. And then you will have to get a new one. So as long as you have this credit product, you can keep reusing that credit that was assigned to you. On a loan, you cannot do that. You have to pay it down to zero. Now, I want to go over the underwriting process. So right now, I want to show you what the process is to apply for either a loan or revolving credit. So let's say you want to get a mortgage. Every time you want to get a mortgage, you have to get underwritten. So it's an every time underwriting process. Underwriting. Okay, so the underwriting process is every time. I want to buy my first house, my second house, third, fourth, fifth, 30th house. Every new transaction has to be underwritten. With revolving credit, it's one time. So the credit card you have in your pocket right now, when you applied for that, you were underwritten by the bank to see if you can qualify for that credit limit. Once you qualified, every purchase you made, you didn't have to go and ask the bank if you were able to make that purchase. So it was a one-time underwriting guideline for infinite amounts of purchase under that limit. So if you have a $1,000 limit or a $10,000 limit, you only have to be underwritten one time to have that limit, and you could buy whatever you want as many times as you want for the life of having that product. Anytime you get a loan, you must underwrite every single time you apply for that loan. So just to recap, a loan has to go down to zero. Whatever you borrow the money for, whether it's a car or a house, at the end of the term, that balance has to go to zero. So with revolving credit, you can even hold the balance. It doesn't have to go to zero at any term. You can always revolve that credit. You can always keep using it. As long as you pay it down, you can reuse that new limit. All right, guys, I hope that made sense to you guys on the difference between having a loan versus revolving credit. If you like this video, please hit like, comment, subscribe, and I'll see you at the next video.
You have not enough minerals.